Hi everyone, and welcome to this month's webinar. Now, this is going to be on the current news that we've been going through, and you've probably seen, you only have to pick up your mobile phone or watch a bit of news on TV, and we're bombarded at the moment with information coming through in regards to the markets, the property market, the stock market, the foreign exchange market, what's being done in terms of the actual from the Chancellor's side in terms of the budget, the mini budget, the reversal of the mini budget. So there's so much happening on a day-to-day basis. It's pretty hard to keep up and keep abreast of everything. It seems as though things are moving at a far greater pace than they have done for a number of years. So it's 100% worth getting this particular webinar in now and trying to sort of wade our way through the news against the reality, because when we have times like this, and I've been through a couple of times where when I first left university and I started in the stock market, that's where I first started. It was sort of 2002, 2003. The Iraqi war just started, so things were dipping, and of course people were panicking. The market, the FTSE at the time was roughly 3,300, 3,400, and everyone thought, what was it going to go to? Is it going to drop? Is it going to go to 2,000 odd? And the same with the property market. The moment you get any kind of sniff of an interest rate change or taxation or a legislation change, people start to panic, and of course they start to talk about doomsday scenarios. But I think the first thing before we actually dive into the webinar is we have to look at the reality of stuff. Is whenever we're in the moment of anything, whenever we're in the moment of any piece of negative news in our lives in general, we think it's the worst day ever or the worst piece of news ever, whatever it may be. But the reality is that we just get through it. If you look back on economic times, it's the same thing. Whenever you're now going through financial instability or economic instability on a micro or a macro front, and we look at the country as a whole. I mean, how often have we seen things like, our GDP or the NHS is underfunded? I mean, how many years can we talk about the NHS is not fit for purpose? We're going to change the NHS, and we're still here 30, 40 years later with the same NHS. So the reality is that we're going to see this stuff all the time. And we're going to see positive and negative economic outlooks all the time. But we have to kind of siphon through that and get to the actual real meat and the real nitty gritty of the news. So the reality is that is there negative news? Well, it depends on what side of the fence you're looking from. But we have to work out if it's negative or positive for you individually. But if for where we're coming from, we're looking to see if this is positive or negative from the actual point of view of the property market. So let's dive in. So what have we got at the moment? Well, we've got a number of different opinions, ranging from people who think the property market is going to dip, it's going to tail off. We've had people, a doomsday scenario, it's going to crash, and I'm going to come to it in a minute. What is a crash? That's the third section. What defines a crash? We're also going to talk about legislation, interest rate changes, tax rate changes that we've seen in the mini budget. Cost of living crisis, how it affects us, and actually how we're going to try and make the current market work for you. So without further ado, let's dive in. So the first thing is that as we come to the different opinions, the first thing that everybody's going to think of, if you had to put money on it, if I said to you, right, you've got to put money on it, and what would you say? Is the market falling or is it rising? The majority of people, and we did a survey on this, and the majority of people would say actually it's falling. But actually that's incorrect. The market is actually increasing. In the last report that came from Zoopla, year on year, the market is still increasing at 8.3%. So where do we get this news from? Where do we get the fact that the market's falling? Well, we get it from papers. You see a headline that says property market falling. And then when you actually read into that information, it actually says that sales haven't taken place at a dip yet. But what is taking place is we're seeing reductions on Rightmove and Zoopla. Now that I totally agree with. We're seeing more reductions on Rightmove and Zoopla at any point in time in the last 3 years. The last time we saw this many reductions on Rightmove and Zoopla was actually just after COVID. So in March 2020. So that's the first thing. Secondly, a lot of people say, well, does that not show that the market is dipping then? Well, no, it doesn't. because what we have to look at is what were the prices in the first place. So if you've got a property, let's say round figures, that you've got a property that would typically go down your street for £300,000, for example. Well, the reality is you may have an agent come along in the previous 18 months and say, well, it's probably worth 300, but you know what, let's put it on for 320, 330 and chance our luck. And you might have had someone come in and buy that at 320, 330. Great, you got a bit of a bonus, but it doesn't mean that all the houses in that particular area jump up to 320, 330. It just means that that particular house is sold for that. Now, what happens now is that the agent might come in and do the same thing. It's worth 320, 330. And then they've realized, well, actually, it's not going to go for that. So let's take a little bit off. Let's take 15,000, 20,000 off to see what we get. And we probably get back down to some more realistic, more normal figures. But the reality is that the actual market and the average price, what things are worth, and not what they are on Rightmove or Zoopla, because to be fair, they're irrelevant. You know, you could get a house that's worth 300 and you can put it on Zoopla for £1 million. It doesn't mean that house is worth £1 million. It's worth what someone's actually going to pay for that. So that's the first thing. That's the first thing. Secondly, what we've basically got to look at is what things are going for in terms of the actual sale price. So in terms of the actual sale price, what we've got to basically see here is the prices, are they actually dipping? And the reality is, no, they're not. So the prices aren't dipping yet. And as I say, we can see here that we're actually still 8.3% up year on year. That's the first thing. Now, are they going to dip? We're going to come to that section in a bit, but are they going to dip? As I say, we might have a bit of a tail off, but we'll come to that in the third section. As I said, adjustments on Rightmove and Zoopla are actually being made. So we can see now that there's a greater number of reductions since we had March 2020. And we do expect prices to level up over the next 6 to 12 months. But leveling up is totally different from a crash, which we'll come to. But in terms of the leveling up side of things, we'll come to that, and we'll come to that shortly. But we do expect the market to be more realistic. It's been unrealistic for the last 18 months. Don't get me wrong, it's great for businesses like ourselves where things have been overheated. But the reality is we do see things that are going to start to level up, and we're going to get back to a realistic market where we were back in 2019 and 2020. But it certainly doesn't mean that we're in crash territory. What we are seeing, importantly, is fashions change. Where we saw the fashions change, and we always said, don't follow the fashions short term, go for the long term fashions. The reality is that we had a big increase in people moving out for space. They moved out for space, and all we hear of now is people moving back into city centres as the need for space has decreased. So why has the need for space decreased? Well, first of all, COVID is well, it's not over, but it's over in the sense of the word that we're not having lockdowns. Therefore, that space is not required as much as it once was. That's the first thing. Secondly, well, the jobs are actually still predominantly in the city centres. That's the second. And why are people actually downsizing now rather than keeping the big properties that they bought maybe during COVID? Well, the reality is the cost of living has meant that heating and supplying gas and heat and electric to your home is actually becoming pretty expensive. So what we're seeing now is where people are going back into the city and getting back to work. They're actually using their employer's heat, their employer's electric throughout the day rather than working from home. And the reality is that if they have a smaller property, a smaller apartment, smaller flat, whatever it may be, they don't need to heat their home as much, and they can save on bills there. So we're actually seeing a big increase in city centre apartments and city centre living than what we had previously. So that's where people are going back to. So what we're seeing is those kind of markets increase whilst the suburbs decrease. So even though we might see a decrease in the suburbs, it doesn't mean the city centres are going to fall in price. So have sales slowed down? Yeah, they have. If we compare 2022 to 2021, sales have slowed. But then what we have to look at is what's behind the numbers. That certainly doesn't mean that things have dipped. And it just means that actually sales have slowed down in comparison to what they were in 2021. But it was so overheated in 2021 that we simply just can't compare. What we should be doing is comparing it to 2019. We can't compare it to 2020 because that was COVID. We can't compare it to 2021 because they were so over inflated in terms of things like when we had the stamp duty relief and things like that. But that sales were always going to have slowed down. So what we have to do is compare it back to things like 2018, 19, and we are not slowing down in regards to the amount of volume and the amount of sales. So if we go back to the last normal year, which was 18 or 19, then we're still ahead of the curve. So what are the facts actually behind the numbers? The reality is the property market is still stable. We're going to come on to future predictions in a bit, but the property market is still stable. There's a lot of talk about what is going to happen, but none of those things have happened yet. They're talking about dips and crashes, but none of those things have happened yet. And as I say, sales are slightly down year on year, but again, nothing to worry about, because the key, it always comes back to supply, and supply is still restricted. One, because we've still got the after effects of COVID from a developer's perspective. But secondly, we're also still looking at things like material costs, although that they are becoming a bit more stable, material costs are still high. So what's happening is developers are not putting a spade in the ground yet in certain schemes, because they're simply saying they're going to wait for things to come back. Therefore, that's restricting the supply even more. And who does it restrict? Well, typically your new properties restrict first-time buyers on the whole more than anything. And again, that then feeds up the chain, which we'll come to in a bit. We then start to head towards the tax. So the taxation, legislation, interest rates. And then again, will we see a change in the mortgage rates? 100% we will. Because we've already seen the rates pick up from ultra lows to 0.25%, where people could get mortgages sub 2. We have people getting mortgages at 1.69% on a resi, and just over 2% on a buy to let. But the interest rates have already increased, but they're not actually having a knock-on effect now. And the main reason being is because people won't actually be affected by this until they actually come out of their fixed rate deal. So if their fixed rate deal doesn't end for another 12, 18, maybe 24 months, depending on what they signed up for at the start, they're not actually going to have a dramatic impact until this kicks in. So we don't think of any kind of dip pullback for at least another 18 months or so in any kind of major way, shape or form, just simply because people aren't going to be affected. And then we've got to look at how they're going to be affected. So if we start to see rates pick up, now this was the big issue in terms of when they did that mini budget. They announced the mini budget, which they were trying to do what's called trickle down economics, where if you have enough growth at the top of the market and the wealthier people, then it trickles down right the way through. It's a bit of an older economic model, and many people say that it actually doesn't work, and it takes too much time to have an impact. But the reality is what we had was the issue was a big push and pull scenario between the main Bank of England and obviously the actual government. So when you've got two of the main staples of the UK economy pulling in different directions, it causes a nightmare for markets, and hence why you saw the pound dip to 104 against the dollar, almost parity. It's gone back up to where it is today, 113, 114, give or take. So what then happened is to get some stability, then the Bank of England had a choice. Well, what do? Now, I thought it was quite interesting that they actually refused to hold an emergency meeting and put up interest rates. That would have been the knee-jerk reaction they could have done. They could have just put up interest rates, 2.5. They could have just said, 3 or 3.25, give or take. That was a knee-jerk reaction, but they decided against that, which I thought was good that they decided against that. And they actually started buying back bonds to support that market and support the pension market. Now, that ended last Friday. And then, of course, Jeremy Hunt has come in and he's calmed the waters slightly. Now, does that mean interest rates are going to now remain level? No, I still think that we're going to have another increase in November. But the fact that we've got a little bit more stability in regards to the Chancellor and both the Bank of England and the government are now pulling in the same direction means that we are not going to have some emergency interest rate increase. Now, we've got to look at interest rates on the whole. They are still pretty much at a low. If we look at history, don't look at the last 2 years, look at the last 40 years. They are still unbelievably low. If we go back 15 years and say that, and said, well, in 10, 15 years, you're going to see a 2.5% interest rate, you wouldn't believe it. But the reality is that's where we are. So they're still low. The problem that we are going to have is that first-time buyers, although interest rates are low, the house prices are too choppy for them to get on board. So what happens? Well, they have to rent for longer. So things might level up once material costs come down. Things might level up as people start to, developers start to build again and the supply gets increased. But the reality is that we're not going to see an easy route for first-time buyers to get back into the market for at least another 24 to 36 months, which means that they've got to rent for longer, which is great for renters. But we are going to see, as I say, a slight increase, I believe, in November. And there's talk of them putting it up to 3.25. I think they will resist putting it up to 3.25, if I'm honest. I think that we might see it top out at 3, and then they'll judge how it goes for a few months, maybe till February. And then they'll see how the land lies with Ukraine, how it lies with gas exports, grain exports, things like that. And then we can start to judge inflation. And potentially, if it sort of peters out a little bit, they might sort of keep it at 3. If we still got inflation there, they might actually start pushing on to 3.25% at that point. But I think we'll probably head up towards 3 in November, and they'll probably leave it where it is until the early part of next year. But as I say, the key for me was that they resisted that emergency rate hike, which bodes well for mortgages long term, because they could have easily just jumped that up. As I say, we do expect the November's rate hike to happen, but nowhere near as severe as what it could have been. And if the government just kept going down that route of tax cutting. We then look at the stamp duty changes. Now, they actually resisted reversing these. So that was great for purchasers. And it affects everyone. It affects sort of first-time buyers. It affects people who are looking at property for a buy-to-let purpose. So it affects everyone across the market. So it's a great time, and especially for overseas clients, it's still really low, entry points for overseas buyers who have got money in either US dollars or AED, whatever it may be that you've got. If the pound is weak, it's a great time for you guys to buy. So the stamp duty has, or the brackets have increased. And as I say, it wasn't reversed, which was fantastic. And it means that we've got a nice bit of leeway in terms of the stamp duty. And it might only mean that you save 2.5, 3, some people push up to 4,000, 5,000 pounds. But that 5,000 pounds could then cover your legal fees, your mortgage fees, etc. And on some cases, it can even get you a furniture pack if you're doing buy to let. So yeah, there's plenty of advantages in regards to those stamp duty side of things, and it keeps it in line with current prices. The stamp duty brackets hadn't changed for years, so they're now far more realistic than they once were. Now we're going to move on to the section which everyone wants to know is there going to be a crash? Now, the first thing that we have to look at is, what is a crash? Because the reality is that many people say, oh, it falls 5%, it's a crash. To me, that's not a crash. That's merely a correction. If the property market has gone up by 15% over the last 18 months, and we dip by 5 or 10%, well, that's still not a crash. We're only where we were 2 years ago. Nothing's really changed. A crash for me has to be 25%. You've got to be looking at 25%, because a crash for me has got to wipe out years of growth. You can't say that there's a crash if we dip even 15%, because that's only 18 months worth of growth, even 20%. Because you're only looking at 2.5 years. If someone said, well, we're going to revert to, 2019 or 2020 prices, that's not a crash. That's just a correction. If we turn around and say we're going to revert to 2014 or 15 prices, that's totally different. We are now in crash territory. So then we've got to look at, well, 25%. Do we think that's possible? And if we did think that 25% was possible, then we've got to look at, well, how long will it take for it to dip 25%? Well, the first thing is, I don't think that 25% dip in the property price is likely or possible for a number of reasons. First of all, is the appetite to buy investments and property when there is high inflation is still extremely strong. The fact that we're not seeing these huge jumps in our interest rates to 5, 6, 7% plus, again, means that mortgages are still affordable. Of course, they're more expensive, but they're still affordable. And another thing is the fact that they were stress tested to a really high amount means that the majority of people coming out of their fixed terms will still be able to go back and secure another fixed 2, 5, 10 years, whatever they look to do. But potentially people will look to fix for a little bit longer. And it means that the affordability will actually still be there. So I don't think that we're going to see this crash at all. But do I think there's going to be a correction? Potentially, yeah. I think that what we will see is realistic pricing, not over the top pricing. Whereas developers and sellers, it was always a seller's market. The last 18 months has been a great seller's market. And I think that because of that, people have actually got well above the asking prices for their property, more than they should have done. And people have been inflated in 10, 15, sometimes even 20%, and they've been getting it. And I think that those days are over. So do I think that, as I say, there'll be a crash? No. A correction? Yes. Then we've got to look at, well, what is that correction going to be? Well, first of all, do I think it's going to be more than 5%? No. I think we're probably looking at circa 5%, give or take. I don't think we're going to be anywhere near the 10% levels. I think we're probably going to head back to pricing of around about sort of the late 2020, early 2021 pricing is where we saw things really start to kick off. But as I say, let's have a look at what that means for you. So if it's a 5% dip, if we see a 5% dip, you're probably not going to see that over a period of a month. It's not like the stock market where you might have a quick correction. Now let's wind back to March 2020. We saw sort of March, April, May, quick correction in the stock market where it dipped, and it was a great opportunity to go in. Everyone thinks that that happens in the property market, and it just doesn't. You don't see crashes, corrections happening over a month-to-month period. They take 12 to 18 months to happen. But during that time, if we see only a 5% dip over an 18-month period, there's no point in waiting. There's 0 point in waiting to buy a property, because by the time you've actually come round to buying it, well, you could have made 10 to 12 to even 15%, depending on time period, in income. So your income's going to easily dwarf the price that you could potentially save. Now let's go to 10%. Again, I don't think we're going to get there, but let's, for hypothetical reasons, say that it dips 10% or that it gets corrected 10%. Well, again, that kind of correction may take 18 months, may take 24 months. So the reality is if you're making 10% per year on your property, you're actually still going to be better off buying property, even with a correction. And then we've got to look at where the corrections are taking place. The reality is they're probably not going to take place in the city centres, because the city centres are denser, they're harder to get good quality properties. And the reality is a lot of people are moving back to the city centres. So where are the corrections going to take place? Well, they're going to take place in the suburbs, and they already are. I'm seeing properties now that went for 450s, 500s in the suburbs start to take little dips on them, only small 1-2% here and there. But the reality is that's where the corrections are going to take place, and that is going to bring the average property price down, no doubt. But again, it's corrections. We're not talking about crashes, and we're certainly not talking about any advantage to wait whatsoever. As I say, I've been doing this for a number of years, and any people that wait over the last 15 to 20 years, anyone that has said to me, I'm going to wait and I'm going to get in at the dip, never makes it. You look at any YouTube video of wealthy investors going to Warren Buffett, his famous line is, if I don't like something for 10 years, I don't look at it for 10 minutes. He's not trying to buy in that dip. It just doesn't happen. And even more so with property. I'm sorry, guys, it just doesn't happen. So the fact of the matter is, if you've made your mind to buy a property and you know that it's the right arena for you, then it's always a good time to buy a property, as long as, and this is the key to this, as long as you're looking to hold it for a medium to long term. If you're looking to hold it short term, my advice is don't buy property at all. You're better going down a casino. But the reality is that if you're looking to hold property for medium to long term, you're going to make money in it. And even if you bought, as I say, even at the height of 2008, and then you held it right the way through the dip, you'd still be well up by now, and you'd have made great income over the last 10, 15 years or so. So then we look at long-term pricing. So what are we thinking long-term? Because this is why we buy property, for long-term, for long-term pricing. Are you looking at a 5-year plan? If so, and we do get a correction, let's say you buy something now and we have a 5% correction over the next 18 to 24 months. Again, it's not a crash, simply a correction. You're still going to make the income. And then after that 5 years, we still expect the market over a 5-year period to be 15% higher than actually what it is today. So regardless of what it did over the next 18 to 24 months, over a 5-year plan, we still expect it. And it's not just us. These are some Knight Franks, Savills. These are some big companies out there that all expect around about a 15% rise over a 5-year period. As we look at a 10-year plan, we expect to go beyond that. Now, there are some companies that expect a 50 to 60% rise over 10 years. We don't. I'm sort of taming it a little bit. We're more around the 35% to 40% mark over a 10-year period. So that's on average 3.5 to 4% a year on average increase. Some years will do better, some years won't do as well, but that's what we expect the property market to increase. Now, that's tame in comparison to what it has done. On average, the house prices right from the 70s, they've doubled every decade. Some have been 140, 150%. Some have been around 70, 80%, but most decades from the 70s have been, on average, they've doubled every decade. So us to say that over the next 10 years, we only expect 35 to 40% is a pretty conservative estimate, but that's where we think that we probably are in comparison to where we are today. And if you take 10 years plus, then I think that it will kick on again once the market, as I say, evens itself out with interest rates. We expect 10 years plus to be great gains in the property market. But the key to all of this is, don't forget, is you're not only making money. Again, I always say round figures. If you've bought a 200 grand property and you've got £50,000 in terms of your cash, any other investment, you only make money on your £50,000. With property, you make it on the full 200. You're making your 10% income, for example, on your 200,000. You're making your growth on your 200,000. Now, of course, you've got costs with that. You've got mortgage costs, etc. But I can assure you, if you average that out, you're making a far higher percentage on your bulk money than you will if you just put, that £50,000 in to one particular investment with no leverage. That's the key. We then come down to the cost of living crisis. Now, how are you guys benefiting from being a landlord? Because that's what we're all here for. How can you still benefit? Well, you invest in properties where you can let both short and long term. That's the first key. So you've got to have properties where you can let both short and long term, because the reality is what you don't want to be doing is putting all your eggs in one basket. And we've seen people do this. We've seen people invest on the coast in Cornwall, and Cornwall is one of the biggest fallers for property currently in terms of inquiries, because everyone was buying on the coast because they thought, well, people during COVID were having staycations rather than vacations. And what happened? Everyone bought in Cornwall thinking, great, I'm making X amount of thousands per week. This is going to continue. And now what's happened is, well, those people will come up to the end of their fixed year deals. People, if they've got a cost of living crisis, well, they aren't going and spending 5 to 10 grand a week in Cornwall, which is they probably were before. So what happens is those markets are seasonal. During the winter months, they simply get very little in the way of short-term accommodation. So we're not saying you buy short-term accommodation, you put all your eggs in one basket there. You want something that you can do both short and long-term, and city centres are the only place to do that. You're going to get great long-term rent there because people want to live there, and you've got great short-term opportunities there because there's great leisure activities, whether that be football clubs, nights out, restaurants, bars, cafes, clubs, leisure activities, arenas, all of that kind of stuff. So both short and long-term is key. Take advantage of all the tax benefits. It's unbelievable how many people get a buy-to-let and they don't speak to an accountant, or they don't speak to us in the office in terms of how best to manage it and what is the best way forward. What they simply do is that they just put it in their personal name, think that that's the only way to do it. And if they're paying 40% tax rate or 45% tax rate, then they're paying that on their gross income coming in for the property. If that's the case, put it into a company name. Or if you're doing holiday lets, take advantage, get it registered as a holiday let, get it registered as a short-term let. And of course, you have to have things like have availability for over 210 days of the year, 105 days it has to be actually occupied for, and not 30 consecutive for the same person. But there's so many tax breaks. And then on top of that, if you do a holiday let and it qualifies as a holiday let, you can do what's called a capital write-down. There's all of these tax breaks that you can do that people really need to take advantage of. And I've spoke to so many people over the last decade who just haven't taken advantage of the tax breaks that are out there. And again, ensure your income is higher than the mortgage rate you're paying. This is basic. What we've seen with some people is that what they've actually done is that they've signed up to some ridiculous mortgage rate. They've not thought about it, and they're paying some high mortgage rate, and then they've let on a traditional let, and actually the traditional let is actually bringing in less income than their mortgage, and they're ended up flat on the actual project. We will always be speaking to you regularly, and we don't only tell you what to get involved with. We actually look at your mortgage rate, what you're getting, what you've been offered, to ensure that it actually makes business sense, because that's what it is. It's not about falling in love with the property. It's not about looking at it and saying, oh, this is a great looking, attractive property. It's a business that you're running. And if the business doesn't make money, you don't do it. And if it does, you do. Forget about what it looks like. It's irrelevant. You're doing this for pure business reasons. That's it. As we then come on, what are renters now looking for? Because that's the key. That's your target market. So again, like we've said before, you're running this as a business. If you had a business that doesn't matter what it was, if you were selling, coffee, and you had a coffee house or sandwich shop, whatever you've got to look at what are your punters buying? What is the best coffee? What makes you the most amount of money? And you sell more of that. and you get more of that in. So what are your renters looking for? So don't go and think, well, okay, I've heard that HMOs are good, so I'm going to go and buy a house, because that's not what renters are looking for. They're actually looking now for smaller apartments in city centre locations. Why? As I said before, the cost of living crisis means that things like your gas, your electric, your heating, the whole lot is more expensive. So it's far cheaper to heat a smaller place up. That's the first thing. And also in apartments, because they're all huddled together, it actually benefits from being better insulated. And ironically, those that are slightly higher up, heat rises, natural phenomenon, heat rises. So the reality is that the higher up you are, the hotter your apartment is. And therefore it's far more beneficial to actually have something that's where you're all packed in. So they're looking at smaller city centre locations. They want a decrease in their daily bills. So gone are the days where they want, swimming pools in their apartments blocks and high-end gymnasiums, because that adds to the service charge. So actually less amenities now is becoming the go-to and the actual de facto, what they're looking for. We're having so many tenants now asking, oh, is there a gym? Is there a steam room? Is there a sauna? Is there a swimming pool? And when we ask why, they say, because we don't want high bills. It's as simple as that. And what happens is the landlord, as in you, have to pay a service charge. And what you're going to do? Well, you're going to put that charge onto the tenants. So they want less amenities. But they do want new, higher quality accommodation. They want better EPC ratings. They want smart features. They want good internet. Is unbelievable in terms of how many people phone us up. And the first thing they ask for is, how quick is the internet? That's what the younger demographic want. So that's what they're looking for. And that's things that we check before we actually launch a development. So it's all about how to make the market work for you. And as I say, you've got to speak to a broker, take advice. So many people, and I do understand this, it's human nature. When you speak to a broker or you speak to an advisor, whatever the industry, you think you're being sold to. You think, what's going to happen? Oh, they're going to sell what they want to me. It doesn't work like that. All of our brokers at Flambar Williams get paid a flat fee, regardless of what they recommend, whether it's a £60,000 property or a £6 million property. They will earn the same amount of money. So they're not sort of thinking, well, actually, I earn more from doing this. So speak to an advisor. They've been there, they've seen it, they've done it. And the reality is if they don't know an answer to the question, they can come to the sales director, Jack, or they can come to myself. They can ask. We've got a research department. There's so many people that they can ask, that they've got the actual research and the actual information at their fingertips. So speak to a broker who's been there before and they've seen hundreds, if not thousands of clients go through the books. Look at historical pricing. Look what happened in the past. Don't judge the market on what it's doing now. Don't read the Daily Mail and think, oh, I'm going to panic. I've got to set everything up. It's doomsday. We're going to have the world's ending. The reality is that we've been through this before. Look at historical pricing. Look at historical interest rates. Look what happens over a medium to long term, and then make your decision based on facts rather than headlines. Headlines do not make you money. Facts do. And then have your property fully managed. We've seen so many people over the years try and manage things themselves, and it just doesn't work. I wouldn't go into an industry and whatever you guys do as a living and tell you how to manage or how to run your particular department. And we say the same thing. Running a property, managing a property, letting a property is a professional job. That's what we do for a living. Use someone. You don't even have to use us. You can use your own management team or your own letting team. But for the price of a cup of coffee a day, the reality is that the management is going to take so much headache away from it, and it's going to make it a really enjoyable process. And ensure that you're in up and coming areas. This is a big factor. This is a tough one that we have explaining to people. We say to you, why, if you were going to buy a stock on the stock market, you don't want to buy something that's had it all. You don't want something that's being purchased. You don't want something that's being done and has already has made great gains and is gone up 300-400% in the last few years, and then you buy it. You want to buy it at the beginning. You want to buy that stock when it's a bit rough and ready. And it's the same with property. You want to be buying in areas which are up and coming, where the council's going to start to renovate, going to start to spend millions on the area. And we know this because we're speaking to the councils. We're seeing what's happening in the area. We're checking the portals, the land registry portals in regards to the planning and what's being done. So we're always looking about what can be done. So buying those up and coming areas. And the last but not least, contact us. If you want to speak to us, guys, as I say, feel free. These are our details. Contact us and just let us know exactly what you need from us. So what period did the latest report cover? I'm guessing these are questions now, guys. Feel free to ask any questions. What period did the latest report cover? I'm guessing this is going back to what the market's gone up by. It went up till the end of September 2023. So from September 2022 to September 2023. We're yet to take into account, obviously, October, but that's where the latest report covered. Unfortunately, I missed the first 10 minutes. Will you be sending this around? Yes, we will. We'll be sending this around to YouTube, and we'll be sending it around to all clients who have signed up. No problem. For a better ROI, this is the next question. For a better ROI, is it better to buy at a lower price? Not saying it has to be the lowest of the dip, but as no one catches that. But is it best to be buying while prices are still likely to dip? Buying last year compared to 10 years ago? Hang on, let's read that again. For a better ROI, is it better to buy at a lower price? Not saying that it has to be at the lowest price because no one will catch the dip, but buying while prices are still likely to dip, e.g. buying last year compared to 10 years ago. Of course, if we could wave a magic wand and, you know, shake 10, 15% off the prices, 100%, you're going to be better off buying a lower price. But what you've got to look at is what you're actually going to miss out during that period. So let's go round figures. Let's say that the house prices were going to fall 10% over the next 18 months, for example. Based on what you're saying there, is you're saying, well, if I don't buy now and I buy in 18 months time, I'm actually going to save myself 10%. So you're going to get a 200 grand property now, or you're going to be paying 180 for it in a couple of years. Yeah, you're right. You will. You'll save you 20 grand. However, our argument and what we're saying here is over that 18-month period, we think we can make you 30,000 in rent. If you rent it out short term, we're making comfortably that in rent. So first of all, if you buy a property now at 200,000, we think we can make you 30,000 in rent over that 18-month period. So the reality is that although you would have saved 20 by waiting, we'd have actually made you 30. So you're 10 grand up by buying now. The second thing that we would say is that inflation in real terms, if you've just got your money sat in a bank, inflation is eating away at it. Most people, what they do is they just start to dip into it. They start to spend it. So unless you're really strict with yourself, inflation and you will just eat into that deposit that you've got. That's the second thing. So the reality is you get to 18 months time and you don't have as much money as you thought you would. But thirdly, and more importantly, is what if it doesn't dip? What if we don't see this dip that everyone's starting to talk about? Then the reality is that you're not gonna you're simply not going to see that dip, and you're not going to save that 10%, and you're going to have lost out on both sides. So the reality is that you've got to judge yourself. We're here to help as well, but you've got to judge yourself. Is that do you think what do you think the market is going to fall by? You know, pick your number. What you think the market's going to fall by, and then speak to us and say what rent do you think we can get income wise, and then we can go from there. And then if we beat what you think is going to fall by, you buy a property. If we don't, then you don't. Simple as that. Gerard, you said you haven't got to September 2023 yet. Yeah, good spot. 2022 then. So 2021 to 2022, that's where it's gone up to. We're still waiting for October's report. If you hold a property in your own name, presumably you can't transfer it to a company you own without incurring stamp duty. That's correct. So if you've got a property in your own name, personal name, and you want to put it in a company that you own potentially, you have to pay stamp duty. That's correct. Stamp duty incentive will not help investors that already own a property is correct. This is only honoured on a first-time property. No, because the bracket has actually changed. Because you actually had a change of the brackets, it does affect you. You still have to pay the surplus. So, for example, the 3% surplus. But because the brackets are actually changed, you will still benefit slightly. Not as much as you could, but you will still benefit slightly. And again, if you're overseas as well. Come here to a Labour government. Would a possible future Labour government enable an increase in supply of properties? What would be the likely effect? Impossible to say. So first of all, on two accounts, what would so the likelihood is if you had a huge supply of properties, that's, you know, basic economics says that, you know, if supply outweighs demand, prices come down. So yeah, that's a given. But would a Labour government enable an increase in the supply of properties? That I don't know. You could have different different housing ministers within a same government, within the same Tory government, or within the same Labour government, and they may have different outlooks on things. So it's impossible to say what they would do. However, let's say they did. Let's say that they suddenly took the shackles off and said, you can now build on greenbelt land or brown belt land. Green belt's the most protected land. But let's say they said that you could build on that land. Well, the reality is the time it takes to get through planning and do prelims on contracts and then build. It's suddenly 5-6 year plan. We're looking at something at the moment in an area in Luton, which is really up and coming in terms of what they're spending on the areas, the governments, and also how long it takes to get into London. And it's 5 years in the making. The guys that got the land, they got it 5 years ago. They've gone through certain planning, and it will be another 4 years until the full development is complete. So the whole thing's a 9-year plan, and that's only on 400 units. So the chances of it having that dramatic an impact, if it got to a Labour government and they suddenly took the shackles off, we're not going to see some instant impact. What prospects are there for foreign landlords acquiring a mortgage at a 55% loan to value in 18 to 36 months? Is he going to profit and at what margin? Okay, so yeah, really good. We've got a few options. It is harder for an overseas landlord to get a mortgage because what the lenders think is that they're not as protected, because if you're overseas, it's easier for you to walk away. So the first thing they do is ask you to put down a higher deposit. The minimum, I would say, for an overseas landlord would be 35%. But if you're talking about putting down 45% and a 55% loan to value, then I've got no doubt that you've got a great chance of getting a mortgage. Now, at what level is the answer? You'll probably be looking at, give or take now, roughly a level of 5 to 5.5%. Roughly, give or take. So would you profit on that? Well, again, if you're doing a traditional let, you'll probably break even on your mortgage part of your investment, but you would make money on your cash deposit. And of course, you'd make money on your growth in the whole property overall. But in terms of your income, that would probably wipe the face, as we say, with your mortgage side, but you will make income on your cash deposit and you'll make growth on the whole thing. However, if you do a short-term let, no doubt it will. So no doubt you'll make great income on both the mortgage side of your investment and your cash side of it, and in terms of the growth overall. So yes. Now let's say mortgages change. There's different options that we get for overseas clients. We can get a mortgage in the traditional sense of the word, but there's also bridging loans for overseas clients, which are far easier to come by. You sometimes have to pay a slight higher percentage, maybe 6.5 or even 7%. But they're far easier to come by a bridging loan. There's less sort of due diligence on bridging loans as they are with mortgages. But yeah, going back to your mortgage question, yeah, I've got no doubt that you'll be able to get one. Lenders currently stress testing 8 to 9% of the 4.5 to 5% we've seen in the last few years. The cheapest fixed mortgage rates are around 6%, far higher than the Bank of England 2.25%. Do you think banks will calm down and price products and stress test based on BOE rates rather than what they're expecting is going to happen? Yeah, I do. I think, and I feel a lot of empathy for anyone who has coming up to completion right now. We are probably in the worst 3 to 4 weeks that we've seen in the industry over the last 20 years, bar COVID. The three worst things that I've seen are 2008-9, when liquidity totally disappeared from the market. The banks just suddenly retracted all mortgages and people were just left stuck. Chains, disintegrated. That was probably the worst I've ever seen, 2008-9. That was horrendous. No one was lending. Anyone that was going through a chain at that time, everything collapsed, and the market only fell 15% then. So that's why we're always really confident in the property market, is that was the worst we've ever seen, and it only fell 15% then. At least now you can get a mortgage. The second worst time is probably, I would say, it's pretty equal between last month and COVID, but I'd probably say COVID has the edge when, again, banks retracted. There's probably about 3,900 buy-to-let mortgage options out there, and it dipped to like 1,800 literally overnight. That was just after COVID hit, March 2020. And then over the last sort of 3 to 4 weeks, we've had a couple of developments that were about to come up to completion. Fortunately, they were delayed completion by 3 to 4 weeks, and it's actually done us a favor, because trying to get a mortgage 3 or 4 weeks ago, they just retracted them. It was just a nightmare. Because of, as I say, the actual push and pull scenario from what people were doing in regards to the government going one way and the Bank of England going another. But stability has been restored, and although I think long term we do need to lower taxes, I think it was just a knee-jerk reaction. Liz Truss thought she was doing the right thing, trying to get something off, off and state her mark, so to speak, and it just wasn't well received. I think that, yes, you are right. I think we're going to start to see mortgage companies calm down. Once they see stability, they get far less jittery. They initially thought that the Bank of England were going to have an emergency rate hike. So they couldn't offer a mortgage based on 2.5% base rate when they thought they might shove it up to 3.5% or 4% as an emergency rate hike. So they just retracted all mortgages. But yes, I do think we'll start to see some stability now. And that's why we're confident long-term in the market. What's the stamp rate for people buying in a limited company at this time? Exactly the same. So same in terms of your personal to your company. The advantage of a company is once it's in a company, the person, if they buy that company, they have a transfer duty rather than stamp duty. So it's advantageous. I thought that there was a way of transferring from a private to company, provided you spent a certain amount of time per week, month running it in corporation relief. It all depends. That's something that, again, yeah, there are ways around it, but traditionally, most people aren't. So we just give a blanket answer of the reality is if you've not been running it, you've been managing it, and you just go straight from a personal to a company, then yes, then the reality is you're going to pay stamp duty on it. But then if you've got a good accountant and you've spent a certain amount of time running it, then yes, there is certain incorporation rate. I believe the corporation tax rate is 19% and the basic personal tax rate is 20%. So it's very similar. If you don't have much UK income, that would take you above the UK rate. Yes, there is. That's right. However, the advantage of putting it in a company is you can claim more things back. So when you actually have in your personal name, you're right, the UK tax rate is 20%, but you're taxed on your gross amount. So let's say round figures, you get £10,000 in, you are taxed straight away on that £10,000. However, let's say you've got the relief. If you're overseas and you sign what's called an NRL1 form, a non-resident landlord 1 form, that means that you can actually claim back the relief that we can here. We get a certain amount of tax, which is exempt. But let's say that you're now making £20,000. Let's say you do a short-term let and you make £20,000. Well, the reality is you're going to be taxed. You're going to get your initial tax relief, which is just shy of 13,000. And then the remaining, let's say £7,000 will be taxed at 20% straight away. However, in a company, you can start to take costs out. So you can start to take your management cost out. If you've got a mortgage in there, you could start to take the interest out. Let's say you've got to redecorate. You can take that money out of it. And you can get that money down to a level where you don't actually have to pay tax on the gross, you pay tax on the net amount. So that's the main difference. We're putting it into a company. You can pay the tax on the net amount rather than on your gross amount. So that's the key with setting up in a company. And then you've got last question here is if I buy using a company, presumably I need to pay more stamp duty than as an individual. No, it's the same. It's the same stamp duty. Well, look, guys, this has been a good one. And obviously, I hope this has helped. Anything that you need, feel free to get in contact with us directly. This is going to be, as I say, uploaded onto YouTube. Hit that subscribe button, of course, and we will send this around to you all individually as well. But from me, take care. Have a lovely rest of the week. And anything you need, just give us a shout anytime. Take care.